Welcome. Today we're diving into an analysis of the U.S. stock market. We've gone through a lot of research, looked at the articles you've shared, and we really want to cut through the noise here.
Mm-hmm.
Find those key nuggets of knowledge. Our goal, to really understand what the market's big data points and trends mean, not just for the global economy, but, well, for you.
That's exactly right. We want to connect these, sometimes complex financial ideas directly to what happens in the real world. This analysis should give you a clearer picture, hopefully encourage some critical thinking about this massive economic force.
Okay, so to really get a handle on the power of the U.S. market,
Mm-hmm.
we kind of need to start with just the sheer size of it all. What are we actually talking about in terms of total value?
Well, based on our research for mid-2025, the U.S. stock market's total market capitalization, that's, the value of all the traded shares together, it's estimated somewhere between 50 and 55 trillion U.S. dollars.
50 to 55 trillion? That's
Yeah.
hard to even wrap your head around.
It absolutely is. And just for perspective, the U.S. alone makes up over 40% of the entire global stock market capitalization.
Wow, 40%.
Yeah. So what that really means for global interconnectedness is huge. A major event, a big downturn in the US market,
Yeah.
it's definitely going to send major ripples everywhere else. It's like the world's financial engine room is right here.
And it's not just the total size, right? It's also where this activity happens, if you break down the U.S. market itself.
Right. So the New York Stock Exchange, the NYSE, that alone accounts for over $30 trillion of that total.
Okay.
And then you had NASDAQ, that's another, $20 trillion plus on top of that.
Right.
But it's also really key to realize how personal this is for so many Americans.
You mean retirement funds and things?
Exactly. The total money in U.S. retirement accounts, think 401ks, IRAs, is over $25 trillion as of mid-2025. Specifically, you're looking at maybe $8 to $10 trillion in 401ks and another $12 to $14 trillion or so in IRAs. So yeah, when the market moves, it directly hits the savings of millions.
Okay, now this next point from the research, this really jumped out at me. While, okay, over half of U.S. adults, something like 162 million people, 62% they own some stock,
Sure.
the actual ownership is incredibly concentrated, isn't it?
Oh, the disparity is, well, it's pretty stark. Our research shows the wealthiest 1% of Americans, they hold about 50% of all stocks. That was valued at $23.2 trillion back in Q1 2025.
Half of it, just the top 1%.
Half of it. And if you broaden that out a bit, the top 10% of Americans hold 87.1% of stocks. That's like $52.82 trillion.
87%.
Yeah. And then, in contrast, the bottom 50% of Americans, by net worth, they own only about 1% of stocks, worth maybe $490 billion. The huge difference.
So let's play this out hypothetically. If there was a massive crash and let's say somehow the U.S. market just didn't recover, who really takes the biggest hit from that lost wealth?
Well, the sheer dollar amount loss would definitely hit the wealthiest individuals and families the hardest, given that concentration.
Right.
But, while the biggest absolute numbers are at the top, the psychological hit across the board, even for people with smaller amounts, that can cause panic, erode trust. And this concentration also means, well, a pretty small group has a huge influence on market moves, maybe even policy. That's its own kind of risk.
And even smaller amounts matter to people.
Exactly. The median value of stocks held by American families back in 2022 was around $52,000. So any big drop still hurts a lot of people's savings, even if the, trillion-dollar figures are concentrated higher up.
This leads to a really interesting question, though. Would the U.S. government ever just willingly let the U.S. lose its position as the global trade leader? Our research suggests pretty clearly no.
Exactly. Maintaining that global trade dominance, it's like a core strategic goal for the U.S. government. There are a few big reasons why.
Like what?
Well, first, it's about power and influence, right?
Mhm.
Leverage and diplomacy, military strategy, setting economic rules. Then there's the U.S. dollar status. Its hegemony as the world's main reserve currency. That's huge. National security is tied into it, too, securing supply chains, energy, critical tech. And maybe most obviously, U.S. exports support millions of jobs and a big chunk of the economy, the GDP.
So how do they actually try to hold on to all that power? What tools do they use?
Our research points to a whole mix of things. Robust trade agreements, a big military presence, protecting shipping lanes, trying to stay ahead in technology, using regulatory pressure, and, really enforcing the dollar system through global institutions like the IMF, the World Bank. It's a multi-pronged thing.
But it can't be easy. Surely there are challenges, cracks appearing.
Oh, absolutely. There are major challenges. You've got the rise of China, for instance, with things like the Belt and Road Initiative and efforts to build non-dollar trade systems like BRICS. Those are direct competitors.
Right.
And then there are internal issues, too. Things like national debt, political divisions, maybe infrastructure problems, losing an innovative edge. Those can weaken you from within. Plus, policies like, say, excessive tariffs, if they're not handled carefully, can actually push allies away, sort of shooting yourself in the foot.
So it's crucial to remember, I guess, that while the government wants to prevent crashes and stay on top, they can't always control everything. Global stuff can change really fast, faster than any one government can react sometimes.
And what's fascinating here, and our research really bears this out, is that the market itself is, well, it's cyclical. It's almost like it has this incredibly complex immune system, always reacting, sometimes overreacting, but it often finds its balance again. Maybe we should look at some of those stumbles and recoveries over the last, say, 30 years.
Yeah, let's do that. That history is important. Where should we start? Maybe the dot-com bubble.
Good place. The dot-com bubble burst roughly 2000 to 2002. The NASDAQ fell something like 78%, about $5 trillion in value just gone. But the recovery kind of led to a new tech era, more sustainable maybe. Then the 9/11 attacks in 2001, the S&P 500 dropped maybe 12% in just a week. That was more about resilience to an external shock, and it rebounded relatively quickly.
And the big one, the global financial crisis.
Right, 2007 to 2009, triggered by the housing collapse, the S&P 500 fell roughly 57% from its peak, caused a worldwide recession. That one led to massive government intervention, new regulations. It really changed the financial landscape.
Okay, what else?
Well, there was the flash crash in 2010. The Dow dropped like 1,000 points in minutes, then recovered fast. That exposed risks in like high-speed algorithmic trading.
I remember that one, yeah.
Then the Chinese stock market issues in 2015, 2016, the S&P dropped about 10%, showed how linked everything is. Brexit vote in 2016, global markets lost maybe $2 trillion in 2 days. Geopolitics hitting finance hard.
And more recently.
The COVID-19 crash, February, March 2020, that was the fastest, roughly 30% drop for the S&P 500 ever. But the government and Fed response was huge, and the rebound was incredibly fast, too.
Yeah.
Then, 2022, you had the inflation and rate hike panic. S&P entered a bear market, down 20% or more as the Fed fought inflation. Shows how much interest rates matter. And briefly, March 2023, the SVB and regional bank scare caused panic, but regulators jump in quickly to contain it.
Okay, and speaking of volatility and maybe government action, our research flagged the Trump tariffs back in 2018, 2019. What did we see then?
Yeah, those definitely caused some serious volatility. The S&P 500 actually fell about 20% in the last quarter of 2018, put it into correction territory that's, down 10% or more from a recent high.
20% is significant.
It is, but here's the interesting part. Despite that dip, the market still finished 2019 up around 29%. Seems like Fed support and some optimism about trade talks eventually won out, so it wasn't quite a full-blown crash, more like a sharp correction the market managed to shake off relatively quickly.
Okay, so let's fast forward again. Bring it right up to date with a really recent case study our research highlighted, the 2025 Trump tariffs. This seems like a perfect example of a sharp drop and then a really, really swift rebound. Can you walk us through what happened?
Sure. So early March 2025, the first tariffs were announced. China, Canada, Mexico. Right away, the S&P 500 dropped about 1.8%. NASDAQ 100 fell 2.6%. Not huge, but by March 6th, the S&P was officially in correction territory, down over 10% from its high in February.
Okay, so already nervous.
Exactly. Then came April 2nd, 2025. Some people are calling it Liberation Day. That's when sweeping tariffs got introduced, like a 10% tax on all imports, plus extra sector-specific ones up to 34% on stuff from China, 20% on goods from the EU.
Whoa. Okay, 10% on everything plus more, that sounds like it would cause chaos. What did the market do?
Chaos is a good word. Volatility doesn't quite cover it. The S&P 500 plunged over 10% in just 2 days.
10% in 2 days.
Yeah. It was its worst week since the COVID crash back in 2020. The Dow fell roughly 1,600 points. The NASDAQ went into a bear market, down 20%. Overall, our research suggests something like $3 to $4 trillion in market value just vanished. Poof!
$3 to $4 trillion. That's massive. But The story didn't end there, did it? It flipped pretty fast.
Amazingly fast. By April 9th, so just a week after that big announcement, markets started to recover. Why? Because the tariffs were paused and trade talks started up again almost immediately.
Wow.
By the end of May, the S&P 500 wasn't just back, it was actually showing positive returns for the year so far.
Wow. From that plunge to positive.
Yep. And by late June, markets hit new all-time highs.
Incredible. So that specific event really highlights how, okay, tariffs can cause these huge, scary drops. But a quick political pivot, getting back to negotiations,
Right.
it can lead to a remarkably fast recovery.
Exactly. It shows the interplay between policy, market sentiment, and, well, the underlying economic forces.
So let's try and pull this all together. What does this mean for you listening?
We've looked at the just immense scale of the U.S. market, how the wealth inside it is really concentrated, how high the stakes are for the government to keep things stable and maintain leadership.
Mm-hmm.
And we've seen this history, this pattern of the market stumbling, sometimes falling hard, but then recovering, even very recently, like with those 2025 tariffs.
Yeah, it really speaks to the market's maybe resilience,
Mm-hmm.
but also how much things like political actions and economic policy influence that volatility and the recovery path. You know, having this knowledge is valuable, but really understanding it, applying it to your own situation,
Yeah.
that's key.
So, given everything we've analyzed, knowing the wealthiest have so much skin in the game, knowing the government has strong reasons to prevent total collapse, and seeing this history of rebounds, a big question for you is, do you trust the U.S. market enough to invest? What really stands out to you from all this information? So, definitely a lot to think about. Indeed, it is. It's a powerful reminder, I think, of just how interconnected our own financial situation is with these huge global economic and political currents. The market isn't just abstract numbers. It really reflects human decisions, fears, hopes, and big strategic plays.
Absolutely well said. And if this analysis helped you connect some of those dots, and you want to keep getting investing talks, more explorations like this one, please subscribe. We're always trying to uncover interesting facts and help you make sense of it all.